Welcome to the Stephan Livera podcast, a show about Bitcoin and Austrian economics, brought to you by Swan.com. Joining me today is the CEO of Blockstream, Adam Back. Welcome back to the show, Adam.
Yeah, thanks for having me on again.
So lots of things happening. We are just recently, as we just coming on to this, we're just seeing Bitcoin Magazine is now getting sued by the Federal Reserve. So have you seen this story?
Yeah, I don't even know. I mean, it sounds like they are saying they don't like that they use their logo to ridicule this
Fed
thing.
down.
But I mean, like for a government to sue a newspaper or, you know, journalists for critiquing a government project, I mean, come on. That's not going to go anywhere.
Right, and I find it just seems very unusual that this was the point that they got really angry, right? Like Ron Paul wrote the book, End the Fed. Many Bitcoiners and libertarians have been anti the Fed for a long time. They've been chanting, end the Fed, end the Fed. How much merchandise is there out there with the words, end the Fed? And this is the thing they get angry about, right?
Yeah, it's craziness.
Yeah. And of course, recently we also saw the news about SBF being found guilty. So I'm curious if you have any initial reactions on that and what it might mean in terms of where the Bitcoin market grows.
Yeah, I mean, obviously it's bad news for him and his immediate family and so on, but you know, it seemed to most people that he took extreme liberties with other people's money, basically, whether that was a rogue trader scenario where he tried to trade himself out of trouble and just got deeper and deeper, or whether he set out to, you know, abuse people's money all the way along. So I don't really know the rights or wrongs of that. But in any case, I think it's sort of ironic, the whole thing, actually, that, you know, because his whole pitch was that he was the well-regulated exchange. And actually they had like a lot of licenses, right? And the US government, like financial regulators gave them a lot of access, more than other exchanges managed to get, actually. So plus the political donations, right? So it's sort of egg on face for all the US financial regulators. But I think, you know, it takes people outside of the Bitcoin ecosystem a while to get over the sort of negative news and to unhook it. You know, they like to sort of attach negative stories to Bitcoin, like it's Bitcoin's fault that this guy stole a bunch of money, right? Well, I mean, so did Enron. You know, there wasn't actually that much crypto related about it. It's like an exchange trading things, and he just took client money, and it took people a while to realize. It's more like a Madoff kind of story almost, right?
Right, and we wouldn't say just because Madoff happened that people should not put anything into the financial markets. Right. You know, like you wouldn't make that analogy, or at least people did not make that analogy. They said this particular fund had something wrong with it, or it was a fraud, it was a Ponzi, etc. Right. And I think the same will happen with Bitcoin, and we are seeing that happening with institutions actually coming. I think that's been a meme for a while. Like the institutions are coming was a meme ever since let's say 2017 with the CME Bitcoin futures, but now it seems to be happening for real, doesn't it?
Yeah, I mean, good timing too, because bonds are having a hard time, and of course these sort of long-dated bonds, if the interest rates go up and they're like 10, 20, 30-year bonds, the face value of them falls enormously. So I saw some news in the UK, some of the pension funds are exposed to a lot of those things, and it's like knocked 50% off the portfolio value of people's pension funds. Now, of course, you can hold to maturity and you get back, the principal plus the interest, but realistically in that kind of duration, however many years is left on those bonds, there'll be so much inflation that they won't be worth much. And that's, I assumed, once they got going on this quantitative easing and enormous amounts of debt in the US and other countries that, they can't afford to pay it back. Like the only way out of this is high inflation, and to just inflate it away, right? So that the real world value of the debt shrinks. Otherwise, they print more money to pay the debt just gets deeper and deeper. So that is, it makes it very difficult for people, of course, to, hold on to a real rate of return on any investment, and calls into question a lot of established kind of long-term investment strategies like the 60-40, stock to bond ratio, managed fund. So, maybe good timing for Bitcoin to be available in a spot ETF, because some of the US funds could usefully pick up a Bitcoin allocation to sort of, as an alternative to their bond exposure, or at least to offset some of the dismal inputs there.
And you're right that it may start with smaller amounts. Maybe there'll be people who go and realize, oh, okay, even if I just have a small allocation, 1 to 5% of Bitcoin, something like that. Of course, if you're deeper into Bitcoin, you hold a lot more than just 1 to 5%. But maybe for people, that's a starting point. That's the dipping the toe. But the challenge that I see around inflation, as you pointed out, is that a lot of people are seeing right now there's a high cost of living, or the cost of living is rising, but a lot of them have not made that connection yet. Do you think there's something that will help them make that connection, or do you think that just most people will not see it, and really it's going to be down to the more intelligent people who grasp that connection between cost of living increases and high fiat inflation?
Well, I think for, developed countries, of course, the consumer price indexes are always manipulated by various factors for political reasons, but, the actual real consumer price index inflation was pretty muted, in previous decades, right? Maybe 2 to 4% or something. And so it's something that, people would get a little bit of a pay rise as they got older on average, and pay would creep up with inflation, and the cost of goods in the store would creep up, or they'd shrink the size of the package so that it shrink. So the price doesn't go up, but the quantity goes down. But, I think it's pretty hard to ignore or not notice when, the asset price inflation is probably 15 to 20%, and even a lot of basic foodstuffs are, or fuel, rent, like just all the things, and of course the interest rates being up. That in some countries the cost of housing is not even included in the consumer price index, and yet people spend typically like 50% of their after-tax income on housing, if not more, right? So it's kind of, for anybody with a mortgage payment, once they come off fixed rate periods, if they have fixed rate, and that will obviously flow through to rents because the landlords have to pay the higher interest. So, yeah, I think a lot more people in economically developed countries will be noticing, and hopefully make the connection that it's not a mystery why the prices are up, but it's because the government just added 50% to the money supply in a couple of years, and what did anybody think would happen, kind of thing.
So, with one other question kind of related to like SBF and FTX, I think there was a lot of talk that last cycle maybe was muted in some ways because of all the paper Bitcoin dynamic. I'm curious if you see a similar thing, like, okay, does it look like we're potentially entering a new bull cycle now? Do you have any thoughts on whether the same thing can happen again? Any comment there?
Yeah, I think that this cycle has been impacted by external factors, which, the COVID and geopolitical instability, supply chains, and like the in-sector stuff, like the FTX itself, and the DeFi failures, and the contagion through, 3 areas: Capital, Celsius, BlockFi, Genesis, and companies and individuals exposed to them. So there's a lot of contagion and high leverage in that stuff. So all of that, got piled up as if it was Bitcoin's problem. Like, COVID, the geopolitical instability, the DeFi failures, and really, Bitcoin is a hedge against a lot of that stuff if you just buy Bitcoin and hold your private keys. And so I think, the market can be kind of dumb for periods of time, right? And so I think the fundamentals are coming through, the Bitcoin dominance is up, Bitcoin is up over 100% year to date, and it's getting more sort of credibility and recognition in traditional finance circles by, the whole slew of major Wall Street firms trying to get a spot ETF through, offering Bitcoin-related investment products to wealth management clients or retail clients. Like Fidelity even has like a retail offering these days, and that's pretty widely used savings institution in the US. So yeah, I actually was thinking we might get, that we would probably, if we hadn't had all of that craziness going on in the external world and in the sector itself as well, that we'd already be at 100,000, like this year, right? And so, or even, last year. So, so my thought is that if some of that can fade and get cleared out, we could get to 100,000 or more before the halving even, and just get back on track of where Bitcoin might have been if you look at, previous cycles and the on average doubling every 2 years, that kind of metric. And then of course, higher after the halving, but we'll see how that plays out.
Right, that reminds me of the panel we did at Baltic Honey Badger recently, which was the when 100K. So, yeah, although I guess you could say historically we've sort of seen like a rise into the halving and then a little bit of a drop after the halving as miners kind of get wrecked, the inefficient miners. And then sort of 6 to 12 months after that is sort of when we've historically seen that bull run happen. But this time, maybe with a Bitcoin ETF, maybe with better understanding, maybe it's different this time. We don't know.
Yeah, well, I'm just saying that, there are two things that can happen. One is, the post-halving effect, which is, it's a real effect, and people talk about it being priced in or not. I think it's generally not. And so that has an impact on the market because the rate of new supply has shrunk, other things being equal. But I think that we're due some upwards recovery just as, the economy gets back on its feet, more people realize that Bitcoin's an inflation hedge. The institutions are adding credibility, so more kind of older generation investors might sort of make the leap, or perhaps, I think a lot of the institutions are actually, they don't necessarily do prop positions necessarily, right? So some of these big institutions are, they run mutual funds and they do asset allocation, but it's not their money, right? So if they feel that they can make an allocation to Bitcoin, of course, could be a good time to do that, right? So in any case, I just think that, those factors could see a pre-halving recovery and then the normal halving thing afterwards, but we'll see if that plays out or not. Depends, on the news flow, I guess, right? If we get some period of no silly news flow that's got, problems misattributed to Bitcoin for a while, then I think we can keep going up.
Yeah, and I think also growing that base of stackers, colloquially people call it maybe the DCA army or the stacking, hodlers. It's also interesting to see some of the statistics that are being shared by some of the on-chain analytics people saying, okay, 80% of the coins have not moved for this period, and that has historically not happened, that kind of thing. Do you put much stock into those kinds of metrics, or do you think that really once the price moves up, that will all change anyway?
Well, it is true that there are relatively few coins remaining on exchanges, but I think that may be part, because some people will say, well, the effect of the halving should shrink over time because it's a smaller percentage change, right? So that's the kind of typical argument against the stock to flow kind of projection and curve fit. But if the hodl wave, i.e., more and more people learning about cold storage, stock trading, cold store, dollar cost averaging, and there ends up being, so for every 4 years, if the remaining coins on exchange more than halves, then the halving can continue to have the same effect. That's what I think. So, yeah, I think it could continue to work. Yeah.
Yeah. Okay. So then we've also got to take into account some of the things that are happening in and around the Bitcoin space, right? So there are, there's always lots of chatter on and about various technological things going on with Bitcoin. So I think recently there's been a lot of chatter in the Lightning Network about replacement cycling as a form of attack, and what kind of mitigations are there against this and things like this. I'm curious if you have any thoughts on this, or whether it's not something you've looked into deeply. But do you have any high-level thoughts on where the Lightning Network is at?
No, I mean, I haven't looked into that. And, there have been a few incremental discoveries over time where, additional design features have to be put in to shore up unforeseen limitations. So we'll see if it presumably there will be some level of mitigation that can be made. And I saw some technical commentators said it's not that much different to some of the other issues. So they're not seeing it as a kind of, showstopper kind of thing, right?
Right. I think that's a fair point. And that seems to be what I was seeing as well from some of the more involved developers and technical commentators also saying that there already are other, known issues around Lightning, that this is not particularly a showstopper per se. But it is interesting seeing some of the way people will latch onto a piece of news and then it becomes part of their narrative of, oh no, Lightning is failing, or it's not developing to the level that it should have. Whereas on the other hand, there are people who are just continually building, it's getting better and better over time, or pointing out that actually there's a lot of people using Lightning nowadays. So I'm curious if you have any comments on the growth in the use there.
Yeah, I mean, it's definitely getting, continuous month-on-month high growth numbers. And so, and new ways to program and use it that make it easier to integrate. So Blockstream has something called Greenlight, which is a sort of non-custodial way to have a lightweight Lightning wallet that's easier to embed in applications and things. So it sort of relies on a server more to do some of the heavy lifting, the storage, the state management, keeping it with the gossip network, doing the routing, and then it sends you enough information to sign. So in a way, it's a bit like how hardware wallets work with on the main chain, which is that, the hardware wallet, if you think about it, it's kind of a surprising how that works. But the hardware wallet doesn't actually know anything about the network, right? You just say, well, I want to pay this address, this amount of money, and the hardware wallet knows which keys you have, but it doesn't even know which UTXOs, right? So you send it a proposal. I want to sign this, and it can verify the amount of Bitcoin in the UTXOs you ask it to spend, and it can display for you how much you're sending and how much change is going back. But that's all it can check, right? So you have this kind of very narrow verification that can have very strong security. So that's basically how Greenlight works at a high level for Lightning. So the trade-off is, some of the wallets have done a pretty good job of, making it feel reasonable, but still ultimately there's a full node and like a pruned full node and a bunch of syncing and state going on a wallet, which is quite a lot, particularly if if you're offline for a little while and you come back or something. So Greenlight has a kind of more lightweight, instant on kind of experience, and it's always, up to date with the network because the server is tracking that. So, and I think Lightning is also getting used for some new things, which is a kind of a connector between different Bitcoin layer 2s, which I don't necessarily anybody saw coming, but it makes a lot of sense, because a lot of people will have a Lightning-enabled wallet, and then it's an easy way to move Bitcoin into, Liquid or Fedimint or Cashew and these new layer 2s.
Right, and that wasn't necessarily predicted, let's say, in earlier years, where maybe a lot of people were operating under this idea that everybody's going to be running like the node at home kind of thing, but maybe it seems that Lightning is also really useful at connecting between businesses. So maybe in a loose sense, you could say it's like B2B or B2C or communities as well. I think that's something that maybe Obi and the Fedimint kind of team are sort of pushing that vision of it as well, that it's like a community custodial thing.
Right, yeah. So Lightning ends up being the way that you move money in and out of those kind of community things as well, which is quite an interesting development.
The lead sponsor of this show is Swan.com. You can buy Bitcoin and learn about Bitcoin over at Swan.com or use the Swan Bitcoin apps available on Apple or Android. Swan recently announced Swan Vault. This is a 2 of 3 multi-signature vault that you can use to secure your coins. And the really cool thing here is obviously you can buy Bitcoin and buy it directly into your own vault. So the setup here is you hold 2 keys in different locations, and Swan can hold 1 key to help co-sign for you where you need that, and also provide assistance and a very slick and easy setup experience for you. So currently this is using Blockstream Jades, and there will be support for other devices added in the future. This is a great way for you to improve your security and not leave your coins with a custodian, but instead hold them yourself. If you are interested in signing up to get on the waiting list, go to swan.com/vault. This show is also brought to you by Mempool.space. This is my favorite Bitcoin and blockchain visualizer. You can see the mempool, you can see the blockchain, you can see second layer networks like the Lightning Network. Over at Mempool.space, you can search transactions and see historical data relating to those transactions. You can see things like the RBF replaced by fee history relating to those transactions. And of course, you can use Mempool.space to target the fee for your upcoming transactions. I use it regularly all the time when I'm about to send an on-chain transaction. Now, Mempool.space can also be run yourself. You can host it yourself. The code is free and open source software. So there's all kinds of features that the team are continually updating. Go and check it out over at Mempool.space. And now back to the show with Adam. And so I think maybe that does bring some potential for conflict as well in certain people, because in their view, the whole thing should be not your keys, not your coins, and there should not be any sort of acceptance of community custodial. But at the same time, there's a tension there in terms of how affordable would Bitcoin be if everybody was trying to be, if literally every user was non-custodial. And I think that maybe that's going to be a source for future arguments in the future, just like we had with blocksize wars. It may come again in the future if not everybody can actually self-custody.
Yeah, I mean, it's a frequent topic of discussion, and not all of the block size war was kind of misunderstanding or silliness or politics. Some of it was a fundamental question, which is, if you run into a limitation with Bitcoin, is it better to provide bearer censorship resistant money to as many people as can use it within the current technology limits, or should we degrade it to like a very centralized thing so that everybody gets an equally, vaguely seizable centralized thing, right? And so what the market said, I mean, I view the block size outcome as a market decision. The market said, we value Bitcoin for what it is, and so we don't want it to get degraded. But that, the free market solution is the people that can pay more are the people who get access. So yeah, it is, of course, as enthusiasts for Bitcoin's use case and differentiated features, we would like if as many people that want it could get the same level of assurance. But I do think the layer twos play a part there because, they are making a trade-off, and some users don't really need to be, on-chain for all of history, right? So, the Lightning kind of retail and micropayment things. Of course, some of the Lightning wallets are custodial even. I think maybe about 50% of the volume, perhaps even, right? Some of the popular wallets actually custodial, but even without the custodial factor, it still adds a lot of scale. And I think that, that and another kind of layer 2 that has that kind of, opt-in optimized for a different case is Liquid, which is like more about trading and stable coins and, security tokens, but basically shares and things like that, which don't necessarily need to happen on chain. If you're moving Bitcoin, for sort of like a more frequent trader between one custodial exchange and another, does the main chain really need to see that? Probably not, right? You could just move that using Liquid. And, if you're actually using Liquid for a trustless trade, probably that's safer than trusting an individual custodial exchange too, right? And there are there's things like SideSwap and TDEX, which are sort of trustless limit orders, things that can even go in a hardware wallet. So you can sort of place a limit order direct from the hardware wallet, sets on a central order book until somebody takes it, and then the assets swap between the two hardware wallets settled on chain. So I think the point is that each of these new layer 2s, they make sense for the people adopting them. Maybe it gives them an advantage for their particular use case, though not a trade-off that Bitcoin itself would want to make on the main chain. But because they take their traffic off the main chain, they make more space, so we get more capacity back for what the main chain can provide, which is the ultimate, sensor-resistant, bearer, cold storage platform and location. So, maybe eventually the technology will evolve to increase the on-chain capacity, using snarks or some of these new technologies. And already, incrementally Bitcoin does quite a lot of innovation that sort of incrementally improves privacy or scalability. So some of the Taproot features result in smaller transactions and Schnorr and music and all these kind of things. So it is incrementally improving. And I was looking at the average transactions per block as a graph. It looks like about 3,000 these days, which is probably up a bit from a few years ago. So there's still capacity there as well.
Right, and so the longer term vision will be that one of those transactions actually contains many transactions. As an example, because there's a lot of batching that can happen, or of course things like Lightning where the transactions have been taken off the chain, or other layer 2s where transactions can be taken off the chain. Some people might, I guess, people who are more outsider to the community might look in and say, well, it seems really Lightning focused. Why is that as opposed to other layer 2 ideas?
Well, Lightning provides actually, a better experience than the on-chain for the retail payments, right? It actually gives you pretty instant finality, which the main chain can't really do. And it tends to be cheaper as well and more scalable. But, it's still, I think people get sort of, they hope there would be a silver bullet, right? But Lightning itself is not a silver bullet, because if the participants have their own keys, they need at least one Lightning channel per user. And as it was Rusty that did the calculation, if you want to get 1 billion people on Bitcoin, it's going to take a while to open that many channels, right? So, but there are sort of, further on, sort of next step incremental optimizations and channel factories and all this kind of thing. So things are continuing to evolve. And I think some of the zero knowledge proof things, which were invented after Bitcoin was released, like the snark concept was invented afterwards. And so there may be some potential there that kind of technology could get, the right security trade-offs that they could become plausible for Bitcoin. Like some of the early ones had novel and hard to trust security models. But
right, like trusted setup and things like this.
Yeah. So some of the more recent ones are getting a bit better. And that might give some new openings. I think, of course, it's potentially problematic to arrive at a situation where, you can't get the history, right? So you've got your backup with a seed. That should be it, right? So you should be able to scan something and retrieve all your unspent coins. And if you have too much of this kind of snark thinking taken too far, then that guarantee will stop being available, and it will be, well, yes, but you have to use some archival thing and trust it. And the problem there is, well, that's just a big block, right? What you're saying is that if it gets too centralized, they might not give you the data back, or there are too few copies or something, right?
Gotcha, yeah. And as you've mentioned, in a big block scenario, if the blocks went bigger than an average, let's say a retail individual, then there is more of a risk that it's kind of a game over because you can't properly sync from zero on an average everyday individual's hardware, I guess.
Right. Yeah, I mean, I think a lot of people have heard of not your keys, not your coins, but I think one of the lessons from the block size was that, if you actually want full sovereignty, then running your own node is actually important as well, because if you're not running your own node, you could, the wallet that's using, some kind of back-end node or exchange, whatever you're using, could put you on the wrong chain, in a fork scenario. So by running your own node and having your own keys, you're pretty much immune from, unwanted protocol changes, basically.
Right. So this is something I'm seeing, maybe not again in the people who are in the hardcore Bitcoiner community, let's say, but I'm seeing people maybe one or two layers out where there's still a little bit of confusion about this. So as an example, I was reading a paper, actually came up in in a libertarian paper, but the guy was basically confused about this idea and saying, he seemed to be under this impression that you could just have a layer 1 system without needing a layer 2 system, right? Like in their mind, they just think that, oh, look, it looks like, the Bcash guys or some other big blocker person has maybe gotten to them and sort of given them this idea that you could have just done it without having layers. What would you say to that kind of person?
Yeah, I mean, it's for anybody who comes from, let's say, a programming background or a computer science background, it's sort of the concept of scalability, something they teach, which is like, an example is sorting. So you have a list of words and you'll sort it, and the simplest algorithm is like a bubble sort, and it's super inefficient. You like sort of n squared or something, right? So you take the first two words, which one's bigger, you swap them, and then you keep going through it, and you do that, like n over 2 times, and it's fine for like a small word list, but chuck in 1 million words and see what happens. And, your computer starts to choke, even if you've got a fast computer, right? And so you try to explain to people that, because I think the problem is that digital things, people don't have an intuition about the scalability of them, right? There's scalability in like material science, right? You can't, you can have an elephant, but something too much bigger, it would break its own bones because it doesn't have enough structural strength. So there's sort of material limitations. And there are also like computer science limitations. You can't just say, well, we'll just broadcast more, because, if you've got a billion humans broadcasting a few transactions a day, it'd like saturate the internet or something, right? And so, it just gets worse and worse. And as it gets more widely used, they have more people that they would transact with. So the number of transactions per person is increasing. And so, that's one answer, that it's not a good idea. And I think the other answer is just a kind of comparison, actually, that basically all networks that people are using are built in layers, whether that's cell phone networks, the internet. They're like switch networks, so they're not broadcast, and that's because broadcast is inefficient. Elon Musk has said some kind of, at times, dumb things about scaling blockchains. And, even Starlink is switched. It's also not broadcast, right? It's doing point-to-point routing because it gives you better utilization if you don't broadcast. You get, more bandwidth for a given set of network equipment, right? So I think that's another argument, is that, for sort of natural physics, mathematics, logic-based reasons, all digital networks have evolved to be switched and layered. And so, why would Bitcoin suddenly be, a different rule? Now, of course, it's hard to guarantee barocensorship resistance in higher layers. And that's what Lightning manages to do, right? It's a switched network, even though it's like backed or guaranteed by the base layer. So, yeah, I think people just don't realize how much bandwidth that could be if, there are a lot of transactions happening in the world globally, retail and share trading and in all the systems, right? If you stuck it all on the chain, the internet would just melt down.
Yeah, of course. And related is people will say, okay, well, look, hard drives are getting cheaper and network speed is getting faster and CPU is getting faster. So could you just explain why, even in spite of that, it's not enough?
Yeah, I mean, it's a fair comment that, equipment gets faster, and you have this phenomenon with, like, let's say video games or software you could buy. It'll give you the minimum suggested hardware. If you don't have a hardware that's got this much storage, this much memory, CPU made, this performance level, it will perform badly. And so it's a kind of recommended machine spec. And of course, computers get much faster over years. But I think the problem with Bitcoin is it's not a stationary target. So, actually one of the challenges is you have to sync the node if you want to be sure that you're on the right chain and verify it. And so I think for a number of years, the chain has been growing faster than hard drives and bandwidth and stuff like that, right? So some people proposed, with so not even big block people, right? But at the time of the block size discussion, that maybe you could try to project what bandwidth growth would be or something, and then they came to realize, oh no, like actually the block history is growing faster than average bandwidth or something, right? And I think the other thing is, because Bitcoin is aiming to be censorship resistant, you kind of don't want to have a minimum spec, which is, 100 megabit DSL or something, right? Which maybe you can get in a major developed city, but it's going to be pretty hard to get in like Nigeria or something. If you look on a map, there's like very few Bitcoin nodes there, and the cost of even basic DSL is like more than a month's salary for the average person, right? So I think you want some kind of, you can't assume nothing, so you've got to assume some kind of reasonable baseline. But yeah, I think the problem is it's growing faster. But there are some hopes there. For example, one technology that we worked with a bit is Robin Linus and some of the developers working on this thing called ZeroSync. Yeah, and the idea there is you can sort of get data a bit faster with less bandwidth, because you can download the UTXO set, which is, I think about quite a lot smaller than the history, because it's just the currently unspent transactions, not all the historic transactions that are spent. And then you download a zero-knowledge proof that proves all the transactions in history up to this point were valid. And the current proof doesn't include signatures, but Bitcoin by default doesn't verify signatures further back than some watermark. It's called assumed valid, which is, I don't know, like a year or two back. So you could speed up a bit, like catching up the history. But, I think you still want to be able to look at the history, right?
Right. And so I think some of these arguments, sort of play into each other. And there are others who make that argument of, well, once we do have, let's say, the likes of ZeroSync or UTXO and others, that maybe then at that point, people would be looking at, okay, now should there be a block size increase? Not now, but in 10 years' time and things. Now, personally, not saying I'm in favor of that, but that's sort of some of the arguments that we're hearing people are making.
I mean, I think one argument which might be persuasive is if the transactions just get too expensive, so that, if a transaction fee ends up costing more than the annual cost of running a node or something, then probably the trade-off is wrong, right? Because one of the nice things about Bitcoin is it gives this kind of asset protection feature to anybody with a smartphone and some basic bandwidth and full node and what have you, right? Whereas people with, enough money to hire lawyers and accountants and, let's say $1 million investable value, they can get asset protection from the current legal and banking systems, actually, right? So, if you get to a trade-off where it's only economically accessible to people with that kind of money invested, then it's lost one of its differentiators. So, but, I think the different layers help scale it indirectly as well, right? Because they take use cases off the chain that don't necessarily, benefit from the chain guarantees as much.
This show also brought to you by CoinKite.com. Over at CoinKite, you can get a range of Bitcoin security gear to help you secure your coins. You need hardware that will help you with securing your coins and keeping the private keys offline, and the cold card is a great tool to do this. With the cold card, you can use it in a variety of configurations. It has been designed to be very secure, and it's actually really not that hard to use. I think people give it a bad rap in certain circles, but really, if you're a beginner, you can just buy a cold card and a USB-C cable and plug it into your computer. Now, of course, if you're intermediate or advanced, you can use more advanced features like air gapping, micro SD cards, or you can use multi-signature or seed XOR and all kinds of other things. But the cold card is still quite accessible in my view, and I've managed to teach people how to use this. So if you're interested in securing your coins, make sure you take them off the exchange, go to coinkite.com and use code Livera for a discount on your cold cards. And now, back to the show. Yeah, of course, and a great example is Lightning with small value transactions that don't necessarily all have to hit the chain, right? So that recent research from the team over at River, where they've put out a report saying the lower bound estimate is 6.6 million per month. And so that's an example where there's all these small transactions that, yes, there was a trade-off, right? Those Lightning users had to take a trade-off of maybe needing an online requirement or something. But in doing so, they are taking the transactions off the chain and then they're making it cheaper for the people who still are transacting on-chain. So right. I think that's also another point that, maybe is not appreciated by some people who are saying, no, just don't even use Lightning, just do everything on-chain. In some way, those people are benefiting from the Lightning users because the Lightning people have taken their transactions off the chain to make it cheaper otherwise on the margin.
Yeah, I think one of the challenges is it's proven to be fairly difficult to make the sort of trustless guarantees to transfer them into layer 2s. So it works for Lightning, but the sort of the idea to have a trustless sidechain has proven challenging. It requires soft fork to implement some opcodes, and those opcodes have some trade-offs. For example, the drive chain trade-off, or the more decentralized version, which has got a fraud proof. And even so, it's not able to get the same assurance as the main chain. And I think people have kind of anchored onto the main chain as, if something is not exactly equal to the main chain, then they don't want it, right? So there's a sort of gold standard so I think people have to get sort of comfortable with trade-offs because, it's, if there was a no trade-off solution, Bitcoin would use it, right? So I think it might just be that, the silver bullet, no trade-off scalability solution is not available. Like, we don't know how to do it, right? So
yeah. The other aspect to this also is paying the miners over the longer term, because even if you were to raise the block size, like imagine 10, 20 years down the line, technology has improved and there's a modest block size increase, there might still be arguments even there, because people might say, well, what about the fee revenue for miners? Because the idea was that the system would transition to fees as opposed to block subsidy, and the block subsidy is coming down over time. And so you can sort of imagine arguments on that line also, that you want there to be fee revenue for miners, and so that's why you shouldn't raise the block size.
Yeah, well, I mean, I could see that, you know, if some of the sort of you know, snark type of things worked out better than expected, we could almost have the opposite problem, right? Which is, you know, there's infinite free transactions, or nearly free. You know, if there's like an excess, then the market will create a low price, right? And then that question comes back. So maybe there are solutions to it too, you know, like a minimum transaction fee or something by policy. But yeah, I mean, so far I haven't been too worried about that, because the Bitcoin price has gone up on average double every year for a decade. Yeah, so for a decade it's gone up 2 times every year, and the halving is only half every 4 years, so it's going up 8 times every 4 years, the reward for mining. So at the moment, the mining reward is growing, right? And I don't think that's about to stop either. So we probably have a few more halvings before this is an issue, and that's quite a long time in. You know, it's some time in technology, but at the same time, you know, like the adoption and awareness metrics for Bitcoin are happening. So, you know, it would be pretty nice to have some scaling tech around about now, right? So that we don't get a lot of, you know, users stuck in custody or something.
Yeah. And speaking of mining, let's talk a little bit about what you guys are doing. There's Blockstream BASIC node. So as I understand, it's sort of, you know, my layman's summary of this idea is that you've observed that in Bitcoin bull runs, the price of Bitcoin mining machines, or mining rigs, goes up even harder than Bitcoin does. And so what if you made a product where people could buy this note, and it's effectively, Blockstream is executing that strategy where you are buying these machines, holding them, and then selling them at a profit in the bull run. Is that the broad idea here?
Yeah. I mean, we arrived at it because we bought a bunch of machines. We do hosting, so co-location for enterprises, so larger customers who want to host, you know, thousands of machines. And so one of the things we found is that if they're new to mining, they just, you know, they make an investment decision, we want to do some mining, and they show up and they expect you to, you know, order thousands of miners and have them arrive within a month. I'm like, no, it doesn't work that way, right? You know, the mining manufacturers who make the miners, they don't have the capitalization to have, you know, $1 billion worth of miners sitting in a warehouse waiting for people to order them, right? It's not, you know, like laptops or cell phones where Dell and Apple have, you know, supply chain and capital to make inventory. So if you want a machine, you're basically paying for it, and then it gets manufactured. And, you know, in a quiet period in the market, that might take 6 months, but in a busy period, it might take 9 months or 12 months before you get the first machines. If you make a big order, you know, you might get, well, the first machine will arrive in 9 months, and then they'll arrive in 12 batches over the 12 months after that. And so, yeah, so we ended up buying some miners just to be able to, you know, give people a better answer, because they get depressed and like go do something else because they can't get the machines fast enough, right? And it worked out quite well. You know, we bought the miners at the time, so the previous cycle, around 25, and some of them, you know, we sold for 60, and the price went all the way up to like 120 and 130. These are dollars per terahash, which is kind of the way people look at the pricing. And so so we're like, well, that worked pretty well. You know, it wasn't an intent to speculate. It was just an intent to solve a problem, right? Which is to have inventory for people. But then we went back and looked at the metrics and did some back testing. And like, wow, you know, actually, even if you bought those machines using Bitcoin before the bull run and sold them at the point where the price was surge pricing, you could have doubled, you know, you could have made a 2x return in Bitcoin. So in other words, the price swing, I mean, of course, Bitcoin has these enormous bull runs that shoot up 10 times and stuff like that, right? But it turns out that the price in ASICs surges even more kind of thing. And yeah, and actually the setup at this point is sort of in a lot of ways better than it was in the last cycle, because you know, what's happened is people got enthusiastic and bought a lot of machines, you know, as Bitcoin was heading up 30, 40, 50,000 and up towards the 69,000 top, and they thought, you know, 100,000 was locked in, right? So they ordered a lot of machines, and it took, you know, a year or two till the machines arrived, and they didn't plan ahead enough to have anywhere to power them up. There's a shortage of hosting. So what's happening at the moment is there is what they call new on pallet. So, you know, shrink wrapped, still in boxes on shipping pallets in warehouses by, you know, people doing mining from the manufacturers, from the lenders who lent the money and had to lent money against the miners and ended up having to repossess them. So there's a lot of inventory sitting around still that's not powered up, which is why the hash rate went up, even though the Bitcoin price was a bit depressed late last year, right? And so what's happened this year is obviously the price is up, you know, over 100%, so over 2 times year to date, 15,500 end of December last year, 34 to 35 now, and yet the price of miners actually fell. You know, so I'd say the manufacturing cost is probably in the $20 a terahash range, and you can buy new machines for, you know, $10 to $15. So that's a very interesting setup, because Bitcoin price has gone up, which improves your buying power, and the price of miners has gone down. You know, so there's probably another 2 times in it or more beyond the surge pricing phenomena. So yeah, we just closed the first series of the basic fund, and, you know, start to put that money to work buying miners. And we don't, you know, we just store them in a bonded warehouse. We don't power them up because people don't like to buy used equipment, basically, right? You know,
right.
There's
a
much better
unopened,
market.
New experience, new
I mean,
miner smell.
Well, I mean, the thing is, if you're buying used equipment, you're always worried that, you know, it's mistreated, it's overheated, it wasn't filtered properly, that kind of thing, right? So even if we said, yeah, we'll treat it nicely, they would still prefer to pay a premium for a new one. So
right. It's a trust exercise.
You know, like in this market, there are probably car manufacturers with, you know, lots of new cars sitting on, you know, car lots waiting for buyers. So it's as if somebody came along and bought a lot of them, expecting an economic recovery to sell them back, right? So you can't, like, you know, start using them, or people, they lose their value as soon as you drive them off the lot. So it's kind of like that, right? So that's what's going on. So we did the series 1, and each series is not fungible because, you know, Bitcoin price is different going in. All the investors actually invested using Bitcoin itself. And the price, you know, the average price of the miners that gets bought will be changing over time. So, you know, but we'll keep running series as long as the metrics hold. And so, you know, at the moment, that was a non-US Series 1. We have a US structure that is getting finalized, put together. So we should have a US series and then, you know, more international series that's actually a Luxembourg securitization vehicle at the top. The other novel part of this fund is it has a hurdle rate, which is the Bitcoin price. So in other words, there's no performance fee unless the fund returns more Bitcoin than you put into it.
Gotcha.
So people are always, you know, rightly not interested or kind of annoyed by crypto funds that charge you a performance fee, like a carry, on a Bitcoin price change, because you're like, well, I could get that stored in a cold wallet without the custody risk, so why should I pay you guys for Bitcoin price going up? So we just took that out of it, and so it's kind of Bitcoin basis effectively, plus management fee and the warehousing fees and things like that.
Gotcha. And so I presume this is done on Liquid as well, right? You can actually hold the note in Liquid.
Yeah. So there's this time it's optional, so you can collect the security token if you want, or you can just have it with the share registration agent, which is a company called Stocker that has the securities licenses and expertise. And the reason we made the token optional is because it turns out that some funds don't know how to hold tokens, or they can't unless they can find a custodian, and it gets complicated. So that if they can just say, well, I'll just own the instrument, then they don't need the token, right? But the advantage of having a token is that you can then potentially trade it on a secondary. So you can use something like SideSwap to do an OTC trade, and as on a BMN, for example, the previous slightly different product, the mining note is still running, and that's trading on Stocker, and we also have markets on Bitfinex securities. So we'll probably look to do a Bitfinex securities listing as well.
Gotcha. So in essence, people have the choice to use a Liquid style token to hold the basic note, or they can go for the more, let's say, TradFi style.
Yeah.
And then basically on the secondary, they can sell this, or they can hold to the maturity, and I presume they receive their Bitcoin back at the end.
Yeah, I mean, that happened with the Blockstream mining note, which it was a 3-year term product, which is running until next July. Yeah. So another 8 months to go. And because again, that was mostly bought with Bitcoin, and the Bitcoiners have a hodl mentality, so most of them are holding it to maturity. But there is a bit of trading, so people are, for tax reasons or whatever
so life
reasons.
Events happen, people need liquidity, all kinds of things.
Yeah. So the optional liquid is interesting, and of course the basic strategy is a kind of one-shot strategy, right? So we're going to buy them, warehouse them, and sell them back, and then wind the series down and pay out the proceeds. So there's no kind of speculative reinvestment, it's a one-shot strategy type of thing.
Right, and because it's a point in time, right? Like it made sense at this time in the market. Maybe in 2 years' time it won't make sense. Right. Or maybe you'd have to wait again till the next cycle around, and then maybe then it makes sense again. Who knows?
Yeah, I mean, I think it might also be, as well as being an opportunity, it might be useful, to the people that are stuck with excess inventory, because it's quite hard to sell, like the prices are low. So they either hold it or they accept, less than they paid for it, let's say, right? And so this will provide liquidity for them as well. And,
right. So you're sort of smoothing out some of the variation in the Bitcoin mining rig market, let's say.
Yeah, I mean, if you buy a lot, you'll support the market a bit. And the liquidity is also Bitcoin basis. And, most Bitcoiners are fairly all in, so that, the prospect of investing in something with dollars is like, where are they going to
go back to fiat,
dollars,
right?
Like,
they
do
want
they
to stay
have
in Bitcoin.
What's that? They don't have any of it, right? Whereas Bitcoin, okay, they could make a small allocation to that and see if the strategy works out. Of course, there are risks, associated, but yeah.
Of course. Okay, so we've spoken about a bunch of things. I guess one other thing, are there any updates you have on Blockstream Green on the wallet side?
Yeah, so we're continuing to sort of add features and improve usability. Also, the Blockstream Jade hardware wallet, integrations with that works on a number of other software wallets as well. And one recent new feature for the Green wallet is the introduction of Lightning using the Greenlight sort of lightweight Lightning experience. And one of the sort of new features of that is the ability to use this kind of hosted node, so kind of lightweight node hosted in the cloud, and to import it into a full node later. So you kind of move it off the cloud and move it into your own core Lightning node.
Right, the offboarding process, yeah.
Yeah. And I mean, I don't know if people realize, but typically Lightning implementations, it's not like Bitcoin where you have a seed. Maybe you have a seed, but you've got to keep the state.
They're not necessarily cross-compatible.
That's the problem, right? So now Greenlight, of course, it has compatibility with core Lightning, and there are a number of other wallets starting to use Greenlight. So you'll be able to import it into Greenlight-based wallets. So you won't have to use that backup only on Green. You could use that on a Breeze wallet and some other wallets that are in development as well, but that feature is still there. So yeah, that's a new feature for Green as well.
Fantastic. Well, I think that's pretty much all we've got time for. So I guess any final comments from your side?
Yeah, I mean, it's an interesting time in the market for Bitcoin. Things are picking up pretty well. I mean, one of the concerns that people will traditionally have as you head towards a halving is the mining death spiral theory, but I think the Bitcoin market has debunked that already because, the price appreciated this year by more than 2 times. So clearly, miners were operating at 15,500 in December, and mining profitability is going to be better now than at that time. So the halving is, could again become a non-event in terms of, impact on hash rate or transaction processing, sort of throughput and stuff like that.
Great. Well, so listeners, find the show notes at stephanlivera.com/523. Adam, thanks for joining me, and I'll see you all in the Citadels.
Yeah, all right. Thanks.